Hey everybody, it's Chad Pavel, CPA, and I have a question here about MSP business valuation that I wanted to answer. A few people have actually written in through the YouTube channel asking about MSP business valuation. How exactly does it work? What are the current, what we call multiples? How do you calculate your EBITDA, your cash flow proxy number, and what does it really mean? What goes into a valuation? So I know there's 5 or so main reasons, but primarily you're going to need to know what your business is worth if you choose to sell it, if you choose to let a partner buy in, if you're looking to sell a portion of it to management, or if you set up an employee stock ownership program, an ESOP. Those are the most common reasons to get a valuation on a business. Of course, if you're buying one too, you want to know what it's really worth. Now, I created a short video here that walks through, there's some slides and some calculations, walks through a side-by-side calculation of a monthly recurring revenue business versus a primarily time and materials business. Now, they both do the same amount of revenue, the same amount of sales, but what you'll see is the composition of the revenue and 4 or 5 other key components drastically will change what that MSP business is worth. And you might be surprised at just how wide of a gap there is in the valuation differences. And I think it'll open your eyes up a bit. Now, regardless if you're looking to sell your business or not, this is definitely a good video. And I'm going to jump right into the computer and show you right now. So I hope you enjoy. Any questions, of course, shoot me a comment, email on the website. We'll get in touch with you. Talk to you soon. Be sure to check out the Tech Succession webinar at techsuccession.com/webinar. Today's video covers is IT business valuation basics. We're going to discuss the core value drivers, how different buyers value MSP businesses and other IT solutions providers, example MSP business models where we compare 2 very similar businesses on paper, but they have drastically different business valuations. And finally, the goal is to help you learn where to focus your time, your money, and all of your resources in the next 12 months to build your wealth through your IT services business. So let's discuss business valuation in general. Well, valuation is the process of calculating the economic worth of a business or other asset for a very particular purpose. And it all comes down to cash flow. Now, the reason to initiate a business valuation and why you would ever even consider it is most commonly around transactions. Whether you're buying a company, selling a company, investing in a company, engaging in a management buyout, or bringing in a new partner into the business, just to name the 5 most common. Now, the other reasons to engage in a business valuation might include tax purposes, evaluating impairment of assets and value, divorce between spouses, partner breakup, regulatory, employee stock ownership program, employee compensation, or other legal and accounting factors as well. And there are many others. But we're going to focus on the transactions today. So regarding MSP valuation, the managed services provider, IT solution provider valuation, it's primarily driven by monthly recurring revenue. And we call EBITDA. It's a very common term. Earnings before interest, taxes, depreciation, and amortization, and of course the profit margins that you have in the different levels of your business, your revenue growth, the long-term contracts you have with your clients, the niche and the verticals that you serve, and the size and stability of your clients, and even the upsell opportunity that you have within your clients are all the more numerical factors that go into evaluation. But primarily you're looking at monthly recurring revenue and the annualized earnings of your business. But it's not just in the numbers. A good buyer will also look at the systems you have in place. They'll evaluate the engineer skills and the leverage that they employ, the sales efficiency, your marketing systems, maybe a secret sauce that you have, a solution, a skill set, a product that you know very, very, very well that few to no other of your competitors can do. That will give you a great edge. Also, the client stickiness that you have, the ability to transfer your business to another buyer are all very important factors when it comes down to the wire in placing a valuation on your business from a buyer's perspective. Now, in reality, your business is worth whatever someone will buy it for. And of course, the fundamentals that lead to a higher business valuation will also lead to more profits, more cash flow, and even more fun in your business. So even if you're not planning to sell your business today or in the next 5 or even 10 years, just know that focusing on building a more valuable, recurring revenue, profitable, and resilient business just makes things more fun and brings out more wealth for you as the business owner between now and the time you do choose to sell. But since you want to know approximately what your business is worth today before commencing a transaction, there are several common methods for valuing a technology services company. And the number one thing that we need to arrive at and agree on is the EBITDA number. And that's your earnings before interest, taxes, depreciation, and amortization. And in short, your business will be valued on cash flow. So EBITDA reflects how much cash flow your business operations drive for you, without considering the taxes and the financing options and the accounting methods that you use. That's what EBITDA is, operational income. And then what we do is we multiply that annualized EBITDA number by a multiple. And that multiple is typically in the IT solutions industry between 4 and all the way up to 10. And that will get you to your valuation. And so that seems like a very simplified way to do it. So let's jump into the details. So your EBITDA is driven by your past, your current, and your future earnings. And what I mean by that is we're looking at all of those things. How quickly have you been growing your earnings? How high of a profit margin do you have? How profitable are your services? How profitable are your employees? And how efficient are you at running your business in general? All of those factors flow into that EBITDA number, that annualized earnings. And then what you do is once we arrive at that number, we'll then plug it into a couple of different models, one being discounted cash flows, one being public comparables, one being acquisition comparables, or a leveraged buyout model. And there are several other methods that a potential buyer or an investment banker or broker may employ to arrive at a business valuation. And the goal of these different models are, again, to arrive at a range of valuations based on market conditions and based on just fundamental accounting. And that's how you arrive at your business valuation. So for purposes of this video, I want to show you the valuation continuum for IT solutions and M&A. So IT solutions providers have traded between 4 and 10 times last 12 months EBITDA over the last several years. And the following exhibit shows the typical characteristics of companies across this valuation continuum. So at the low end, a sub $1 or $2 million company that has subscale, maybe they're very local, very regional, they're probably going to get a valuation of between 4 and 5 times. And again, if you're selling a lot of hardware, a lot of time and material services, and one-time software solutions, you're probably going to fall in that 4 to 5 times range. So take your annual EBITDA and multiply by 4 or 5, and that is your approximate valuation. Now, when you start moving up to a more valuable business in the 6 to 8 times valuation range, you'll get there by building a more scalable company. The biggest part is just growing revenues. And of course, having more recurring revenue, more high margin services, reducing your reliance on hardware sales to drive value. And as you move up to the 8 and even 10 times multiple range, you're looking at a very meaningful managed services recurring revenues business. We're talking 60, 70, 80% recurring revenue. The higher contract value, the better. The longer term the customer contracts and the larger and more profitable your customers, the more valuable your business will be, since, again, your business's value is primarily, and some would argue solely, on your ability to generate predictable cash and protect against downside. Let's look at 2 similar companies that have 2 very drastic valuation differences. Company 1 is a $2 million revenue, about 25% in hardware, 10% monthly recurring revenue on loose contracts, and the rest is time and materials, hourly billable rates. They have 18 staff and really no sales staff in the building. Most of this business has been generated through referrals over time, and they've been growing very slowly at about plus or minus 5% over the last few years. Only $100,000 in earnings. So still a profitable business, and it's generating pretty good cash flow, but 5% tends to be towards the bottom of the MSP valuation spectrum. So what we would look at is around a 5 times multiple on this one, on this particular company. Now again, a different buyer might value it at 4, a different buyer might value it at 7. There's a lot of things that we don't know about this business, but on paper, a business with a rather low profit margin, little to no monthly recurring revenue, and little staff leverage, low staff leverage, will be looking at a valuation multiple in that lower range. So that might be a little disappointing to you as a business owner if you're in that ballpark, but I want to show you how you can pretty quickly and pretty drastically change the valuation of your company by focusing on a couple different levers. So let's look at company number 2. Now, company number 2 might seem very similar on paper with $2 million in sales, but the components of that revenue are massively different. They're generating 90% of their revenue in services, 70% in monthly recurring. They have 10 staff generating $2 million in sales rather than 18. They have 30% year-over-year growth and $400,000 in profit in EBITDA cash flow, and that's a 20% margin. And at an 8 times multiple as defined in the previous slide, that could be a $3.2 million valuation for this similar size company. So what are the big drivers here? The components of revenue, staff, how much revenue they generate. No sales growth, low margins. Compared to company 2, high concentration of recurring revenue contracted services, 10 staff, so great leverage, including a defined sales team that's helping the company grow at 30% or more each year, and a very high profit margin. That's leading to a 6 times valuation difference for two companies that might seem very similar on paper. So what drives down your valuation? Having time and materials as the main revenue driver, general or little focus, stagnant or no growth, the owner is doing much of the work, no lead generation systems, non-repeatable processes, large vendor sprawl that's leading to inefficiencies, and no client documentation, meaning transferring companies or clients will be difficult. Now, what can you do to increase your valuation? You can focus on recurring revenue services, build consistent revenue and profit growth. So get out there and sell and grow and upsell, cross-sell, whatever you need to do. Focus on a couple of industries or at the very least clearly define the services around very profitable growing industries. That will help you, of course. 1, 3, 5-year contracts for all clients, high margin services, recurring product commissions from your vendors. That pays you every single month. Add more sticky services and products, build repeatable, transferable processes, and work on your secret sauce, that one thing that you do differently and much better than anybody else that solidifies your demand in your marketplace. Be sure to check out the Tech Succession webinar at techsuccession.com/webinar.